Welcome to Breaking News to Trading Moves. Today we're focusing on a specific headline. It involves Amazon and the Federal Trade Commission, the FTC. We're going to look at how that development is noted to affect different market segments.
Okay, so the main event is this settlement. Amazon and the FTC settling over Prime's sign-up and cancellation processes. The FTC called them dark patterns, basically making it confusing for people to sign up, or, more importantly, cancel.
Like hiding the cancel button, that kind of thing.
Exactly, making you click through multiple screens, unclear language, all that.
And there's a pretty big price tag attached.
Yeah, $2.5 billion total.
How does that break down?
It's a $1.0 billion civil penalty that goes to the government. And then $1.5 billion is earmarked for consumer refunds, people who got charged improperly.
Wow. Okay, but beyond the money, there are changes Amazon has to make, right?
That's really key. They have to simplify the whole Prime sign-up and cancellation flow, make it much more straightforward, and add really clear disclosures about the subscription terms right there when you're signing up.
So less friction to cancel, maybe a bit more friction to sign up without realizing it.
You got it. And that changes the dynamic for their subscription model.
Right. So the analysis we're looking at suggests this could open things up competitively. Our goal here is to see which companies are noted as, well, potential beneficiaries and which might face some headwinds because of this. Let's maybe start with the potential winners, the companies that could gain.
Sounds good. The thinking is, if people feel less locked into Prime, they might behave differently.
Okay, so what's the first category?
The analysis points to omnichannel big box retail. The rationale is, if Prime members aren't quite as sticky, maybe they start comparison shopping more often, checking prices elsewhere.
And the names mentioned are Walmart, that's ticker WMT, and Target, TGT. Why them specifically?
Well, it comes down to their existing setup. They offer quick ways to get stuff without relying just on fast shipping like Prime. Think about Walmart, WMT. They've got really strong curbside pickup, next-day delivery options already in place.
So they can catch people looking for value and convenience even without a Prime membership.
Exactly. They're positioned to grab shoppers who might now switch, looking for immediate options without that subscription tie.
Makes sense. And Target, TGT, is similar then.
Yeah, very similar logic. Target has its drive-up service, which is super popular, and the Shipt partnership for same-day delivery. So if someone's less inclined to just default to Amazon, they might give Target's quick options a try.
It's about capturing those incremental trips, those extra sales from shoppers who aren't automatically clicking buy on Amazon.
Precisely. A potential boost directly from folks reconsidering their default shopping habits.
Okay, so beyond the big box stores, what's next?
Alternative marketplaces.
Okay, I think I see the connection. If Prime is less sticky, maybe people explore other online platforms more.
That's the idea. It could lead to a lift in what's called gross merchandise volume, or GMV, for non-Amazon sites.
Which ones are highlighted?
eBay, ticker eBay is mentioned. With comparison shopping potentially on the rise, a platform known for value, maybe used items, auctions, they could see more traffic.
eBay is kind of built for that bargain hunter or specific item searcher.
Right, they just need those shoppers to click over more often.
And Etsy, ticker ESY.
Same basic principle, but slightly different angle. Etsy's all about unique, handmade creator goods. If the perceived convenience advantage of Prime shrinks a bit, if instant delivery isn't the only factor, then the effort of going to a specialty site like Etsy feels smaller.
So the trade-off between speed from Amazon and uniqueness from Etsy shifts a little.
Yeah, potentially making Etsy look more appealing for certain purchases.
Okay, that covers marketplaces. The third group noted for a potential upside is open web ad platforms. How does that connect?
This follows the money.
Yeah.
So Amazon has this big advertising business, right? Brands pay to promote products on Amazon, retail media.
Right, sponsored products and stuff.
Exactly. Now, if these changes make it harder to sign up for Prime or easier to cancel, maybe shopping frequency or conversion rates on Amazon dip slightly, if the ads on Amazon become a bit less effective at converting sales,
then the brand spending money on those ads might look elsewhere.
That's the theory. Ad budgets might rotate to other platforms where they feel they can get better results or reach shoppers differently.
And the analysis points to Alphabet, GOGL, and Meta.
Yes. For Alphabet, which is Google, you're looking at budgets potentially flowing into ads on Google Search or YouTube, reaching people earlier in their shopping journey.
Okay. And Meta, Facebook and Instagram.
For Meta, things like their Advantage plus shopping campaigns or dynamic product ads could benefit. Brands might use Meta to target or retarget shoppers who are maybe spending less time directly on Amazon. It's about diversifying that ad spend.
So if Amazon's ads become slightly less certain bets for immediate conversion, the platform's good at driving general traffic or targeting specific users might pick up those dollars.
That's a good way to put it. A potential shift in where the advertising money flows.
Okay, so that covers the potential gainers, the big retailers, other marketplaces, and the big ad platforms. Now we need to look at the other side. Which companies might face some pressure from this settlement?
Right. Let's start with the most direct impact. Amazon itself and companies closely tied to its ecosystem, especially financial partners.
Obviously, Amazon AMZN is first. There's the $2.5 billion payment. But what else?
Well, beyond the cash, it's the operational changes we talked about, making sign-up potentially harder and cancellation easier. They could hurt new member growth. And it might increase churn, people leaving Prime. Lower conversion rates, maybe lower ad effectiveness too.
And that has knock-on effects for financial companies linked to Prime members, right? Like Bread Financial, BFH.
Exactly. Bread Financial, BFH, issues private label store cards, including ones likely used frequently by Prime members within Amazon. Their growth relies heavily on acquiring those high-frequency Amazon shoppers.
So if fewer people sign up for Prime or they shop less before canceling.
Then the growth outlook for Bread Financial's Amazon-related card portfolio could weaken. They're quite exposed to Amazon's retail health here.
Okay, that leads into the next category noted for potential headwinds. BNPL and other checkout partners tied to Amazon.
Yeah, any slowdown in Prime-driven shopping could mean lower overall transaction volumes flowing through those partners.
Affirm, ticker AFRM, is mentioned here. They're the buy now, pay later partner for Amazon.
Right. BNPL helps boost transaction values, getting people to buy maybe slightly more expensive items. If Amazon's overall sales volume, its GMV, softens even a bit, or checkout frequency dips because fewer people are locked in Prime members, Affirm feels that directly, lower volume for them.
And Synchrony Financial, CSYF, they partner on the Amazon store card too.
Similar situation to Bread Financial. SYF could see pressure on the growth of that private label card business. These cards are designed to create loyal repeat customers. If the stickiness of Prime members decreases, you have fewer guaranteed repeat shoppers using that card.
So less reliable growth for that card portfolio.
Potentially, yes.
Okay, the final category facing pressure is a bit different. It's subscription-heavy consumer streaming services. How do they get pulled into this?
This one's about precedent risk. It's less direct, more about the signal this FTC action sends.
What do you mean by precedent risk?
Well, the FTC successfully went after Amazon for dark patterns, specifically related to subscriptions making cancellation hard. The precedent suggests that regulators might now turn their attention to similar practices in other subscription-based industries, like streaming.
So even though it's not about Amazon Prime Video directly, streamers like Warner Bros., Discovery, WBD, or Paramount Global, PRA, might be affected.
That's the concern noted. The focus is on cancellation friction generally. Streamers like WBD and PRA might now feel pressured to review their own sign-up and, crucially, their cancellation processes to avoid similar regulatory scrutiny down the road.
And making changes, even proactively, costs money and might hurt business.
It could. They might face, 1, higher customer acquisition costs, or CAC, if they need to replace customers who can now leave more easily. 2, maybe higher churn rates if that cancellation friction was actually keeping some subscribers around longer than they wanted. And 3, just the operational cost of updating interfaces, making sure they're compliant globally with this potentially emerging standard of easy cancellation.
So easy cancellation becomes a potential cost center or a drag on subscriber numbers.
It could, yes. It changes the calculus for managing those subscriber bases.
Okay, this really wasn't just about Amazon then, it seems. It touches on the whole subscription economy model, potentially.
That's the broader implication, yes.
Yeah.
Anyone relying on auto-renewal with maybe a tricky cancellation path might be looking over their shoulder now.
All right, let's try to summarize this based on the material. We essentially have two groups of companies highlighted.
Yep. On one side, potential beneficiaries, let's call it a long basket idea. That includes the omnichannel retailers, Walmart, WMT, and Target, TGT. Also the open web ad platforms, Alphabet, GOGL, and Meta. And the alternative marketplaces, eBay, and Etsy.
Etsy. Got it. And on the other side, the companies facing potential pressure, the short hedge basket.
Right. That includes Amazon-tied finance partners like Affirm, AFRM, Synchrony, SYF, and Bread Financial, BFH.
And the streamers facing that precedent risk.
Yeah, Warner Bros., Discovery, WBD, and Paramount Global, PSO, were noted there.
Okay. So this whole discussion really stemmed from the FTC targeting that consumer friction in getting out of a subscription.
It did, which leads to a final thought, something for you, the listener, to consider maybe. Given this action against e-commerce subscriptions, what other areas, maybe in consumer finance or just general marketing practices, rely on similar kinds of friction? Where else might regulators look next if they're focused on making things easier for consumers to manage or cancel commitments?
Something to think about. Where else do you run into that kind of resistance as a consumer? And just to be clear, this is not financial advice or buy or sell recommendations. This is purely the opinion of the author.